Hello there. Welcome to Alternative Investing. I'm Andrew Bell, and here with me, my regular Friday co-host, David Kaufman, president of Westcourt Capital. Great to see you again,
Great
David.
to be here.
On this show, we explore investment concepts outside the traditional realm of stocks and bonds. It's for investors like you who may be sitting on cash, looking for alternative places to put that money. Places not in the public markets, but in funds or products that fly a little more under the radar. On today's show, micro-lending, person-to-person loans. Now, we're not talking about the Godfather here, I don't think, David. Can you explain what is this all about?
Sure. Lending between individuals has existed as long as there's been currency. So if we do a quick sort of 1,000-year survey here, it always started out as, before there were banks, there were still loans. And so that two people, a borrower and a lender, would have to somehow find each other. So that had obvious hurdles, which is that you had a regional problem where you had to actually be able to find the person and they had to be close enough to be able to transact. And then you had a practical hurdle, which is that one side or the other might have not full information about how to make a loan, how much to charge, how to collect, what to do if they didn't collect. And so eventually, as banks became sort of the great intermediary between borrowers and lenders, that is how it's worked for hundreds and hundreds of years. Now, that's expensive, but somewhat efficient. In the internet age, especially with what is generally referred to as Web 2.0, you have this massive disintermediation among all sorts of people that want to find each other. So it could be dating sites, or it could be eBay, which is a perfect example of buyers finding sellers that never would have found each other before.
Cutting out the middleman.
Cutting out the middleman and having a new middleman, but a very small middleman, taking a small clip along the way, kind of like a toll booth. And that's what's happened in the world of consumer credit and person-to-person lending, is that you have sites. It started in the UK with Zopa, then you have Lending Club and Prosper in the US, that act as this sort of instant intermediary, non-bank intermediary, to help the borrowers find the lenders and vice versa, and allow that transaction to happen in a relatively efficient and certainly in a low-cost way. And it's interesting, unlike eBay, for example, where it's an auction to the highest price, the auction that happens in this case is a reverse auction, because the lowest interest rate that's bid for a particular loan wins. Now, the middleman, the site or whatever, typically will check out the borrowers to some extent? Yes, they provide a number of key roles, actually. So the first thing is that they have to qualify both the lenders and the borrowers. And qualifying at first, of course, you have to ensure that these people actually exist. So you have identity verification, creditworthiness, which I'm sure we'll be talking about more later in the show. And then they have to play that actual matching role. There has to be the website, there has to be the platform on which people can see each other. And then they also play the role of formalizing the terms and agreements. And that's very important, because if you can standardize the terms and conditions in a loan document, both sides will understand sort of what they're getting into, and then loan servicing, of course, is critical, because it's not good enough just for the borrower and the lender to find each other, but there has to be a system through which, like a clearinghouse, essentially, through which the principal amount gets loaned from the lender to the borrower, and then those payments have to come the other way, and so that you need a third-party facilitator to make that efficient and make it streamlined enough that basically, if everything works out as planned, when you look at your bank statement in real time, you can see the money flowing in every month or every quarter, or whatever it is that particular deal called for in the circumstances.
But I won't know the person who's borrowing money off me?
You won't know the identity of the person, his or her name, but you will understand what type of person they are. And that's really the key thing, is the metrics that we'll point out later that are so important in assessing what we call adjudicating the creditworthiness of a borrower, so that we really know who we're dealing with on both sides of the balance sheet.
We saw a Canadian version of this P2P lending launched last year. Tell us about that.
Well, P2P lending is a little bit different than community lend, we'll be talking about today, because it involves it involves venture capital along with loans. And so the difference there is that if it's venture capital, it's still the same idea. It's the disintermediation. It's letting investors find people that require capital, but it's not quite as pure as what we've seen in the U.S. and the U.K. and what we see with community lend. Remembering that the vast majority of these loans are, at least the way they exist today, being used to refinance credit card obligations. that is something that everyone hears about on a regular basis, which is that consumers walk around often with large balances on their credit cards. In recent years, it's gotten a little bit better, but they're not usurious rates, but they're very, very high compounded interest rates, often north of 15 to 20%. And as we see here, a lot of people say, I'm going to go to one of these, to a P2P lending site to borrow, say, $10,000 so I can pay down my credit card that maybe is at 17 or 18% that compounds monthly, and replace that with a longer-term, lower-interest loan that makes more sense for me in the short run and in the long run. So
we're going to get into the regulators here, but
yes.
Who would typically regulate this thing?
It really depends on how you see the intermediary's role. It comes down to the issue of are these securities? Because regulators typically regulate the transactions of securities. And so a loan is a security. There's no doubt about that. But it depends on the role that you're playing in the middle. And if you're acting, doing things that trigger dealer-like activity, then you'll have to be regulated. And in Canada, we have a strong regulation system that allows for it to be regulated, for the intermediary to be registered with, say, the Ontario Securities Commission or whichever commission would apply under the circumstances. And this is one of the things that's happening in the U.S. and the U.K. is that the regulators are starting to say this is becoming something that we have to pay attention to, because you don't want either the borrowers or the lenders to find themselves in a situation where what they ended up getting, the product that they thought they were getting into, was different because they may have been misled by an unregistered intermediary, and that's where the concept of regulation comes back into play.
Well, coming up, we're going to find out what's happening in this lending space. Our guest will be Michael Garrity, CEO of Community Lend. Welcome back to Alternative Investing. I'm here with David Kaufman of Westcourt Capital. Today we are talking about peer-to-peer lending, and our guest is Michael Garrity, CEO of Community Lend. Great to have you here.
Thanks for having me on the show, guys.
What does Community Lend do?
Well, I thought you guys did a great job introducing the topic. Thank you, David. Community Lend is an online loan marketplace. It's an opportunity for borrowers and lenders to bypass the bank and form binding loan agreements through our website. For lenders, it's an opportunity to build a portfolio of consumer loans that have a yield signature that they're comfortable with. And for borrowers, it's an opportunity to get real competition for their loans and to try to get a better rate.
And what specific services do you provide sort of from beginning to end?
Sure. So we are an administrator for both sides, both the lender and the borrower. On the borrower side, we do what a bank does. So we have to qualify the borrower, make sure we know who they are, ID verification, integration into their bank account. We pull credit history. We then validate elements of volunteered data from the borrower during the application process. You have to meet a minimum standard in order to be able to list a loan at our site. And then on the lending side, we package up the borrowers based on the metrics that we've come across. We form binding loan agreements. We report those to regulators, which we'll talk about, I think, a little bit later in the show. And then we manage the loan during its duration.
So what kind of lenders and borrowers? I gather a typical loan for you guys would be around $7,000?
Yeah, so that's today's average. We can do any loan between $1,000 and $25,000, but today we're averaging about $7,000. The typical borrower for us is somebody who's looking for an unsecured loan over a 3-year duration for anything from paying down their credit cards to making a home improvement to buying a car, the typical baskets of things you'd use an unsecured loan for. On the lending side, we can only take accredited investors at the moment, but we appeal to both individual and institutional accredited investors interested in a fixed income type of product that they can manage themselves.
Of course, from the point of view of the investor, in this case the lender, they're going to compare this against sort of the array of other options that are available to them in the fixed income space, in this case the unsecured fixed income space.
Right.
What would they see if they were making comparisons in terms of risks and rewards? Yeah. What do you think that calculus would look like as they went through it?
So our target with our investors or our lenders is to get them anywhere between an 8 to 10% net return after our fees and after any defaults that they would have in their portfolio.
Annually.
Annually, that's correct. And there are other sites that we took a lot of our cues from when we created Community Lend that do just that and have been able to achieve those results.
Credit risk in the fixed income world is obviously the biggest risk.
Right.
It's one thing to get all of your interest, not get all of your interest, but principal preservation is obviously a very important part of this.
Absolutely.
So at the beginning, ex ante, what metrics do you use to measure the creditworthiness of a borrower that you can, and be a little bit specific so that the lender says, I understand what I'm getting myself into here and I'm getting paid back?
Yeah, for sure. So the benefit of the consumer credit industry is that it's been around for a long time and the metrics have been tracked for a long time. Mm-hmm. So when every borrower enters the system, we do ID verification. We pull their credit history from our partner, which is the largest credit bureau in Canada. That's the same methodology that a bank would use to start a loan application process with a borrower. And you literally pull on 50 years of accumulated data that says if you're between this band in the credit score, your likelihood of default looks like X or Y. So we set those criteria up, articulate those to the lender to say we're going to charge this borrower a little bit of a higher rate because they have a higher likelihood of default. We're going to charge this borrower a lower rate because they have a lower likelihood of default. So it's an industry that's got an ability to place in a historical context, which I think is quite good.
If I'm one of your investors,
yeah,
and David borrows from me and David defaults,
yes,
what comeback do I have?
Yeah, so as part of your relationship with us, you charge us as an administrator on your behalf of your loan portfolio. This gives you literally the ability to be a bank without having to set up a banking license and a banking set of operations, mm-hmm, because we're managing the operations of loan performance. So if a borrower goes into delinquency, which that's not default yet, that's just that they're missing payments, then we follow our collections procedure, which is outlined on the site. We contact the borrower, we work to try to get them whole again. And if we are unsuccessful at getting the borrower to get back on their payments, then we assign that loan to a collections agency, the same collections agencies that are used by the big banks to collect on their loans.
If we're talking about, to use the example of, as we mentioned, the majority of this may be to refinance credit cards or a home improvement. In the credit card scenario, if someone's carrying a big balance and they want to refinance, I want to make sure I understand this, that we're not talking about deadbeats. We're talking about people that are carrying a balance and they look at the interest rate and they think there must be a better way.
Absolutely.
And if they have a credit card in the first place, they must have already been adjudicated by the provider of the credit card, the bank that provides it. So I'm assuming that they already, if they have a credit card that it hasn't been cut up yet at one of the vendors, that they still have some creditworthiness probably built in there.
Yeah, for sure. And I think what's at the base of your question is how do you make sure that your website is kind of deadbeat free, right, as a general rule. And I think you can never assure that 100%, but the adjudication methodologies that we follow are very similar to what a bank would do. The only customers that we let list loans on the system are the same customers that a bank would accept in one of their credit products. Wouldn't be necessarily a homeowner line of credit, but it could be an installment loan or a credit card loan. So those are the only customers that we let list a loan on Community Lend.
Of course, one way to manage risk is through diversification.
Correct.
So I'm watching this show. I say, I've got $100,000. I think this might be an interesting way to invest it, but I'm not going to lend it to one person.
Right.
So how do you help me find, say I want to split it up 10 ways.
Right.
How do you help me find 10 loans that have similar attributes so that in the aggregate, the 100,000 is on a weighted average at similar risk across the board?
Sure. So we'll talk about individuals versus institutions because both can participate. As long as you're an accredited investor, both can participate on the system. And we have both, but incidentally, both institutions and individuals who are participating as lenders. If you're an individual, we force you to diversify. You can never take more than 10% of any loan that's available on the system. We force you to diversify.
Sorry, just clarify that, 10% of any loan.
Yeah, so if there's a loan on the system for $10,000, you can't take more than $1,000 of that $10,000 as an individual lender.
Okay, so I came to you and I wanted to invest $100,000 with you.
Yes.
So would I find myself in 100 different loans? I don't quite follow that, sorry.
Yeah, so your loans could easily be 100 different loans to get that diversification.
I see.
And you can either do that yourself by selecting loans in the marketplace and bidding against them directly, or you can use one of our automated tools. So you would say, I'm only looking for AA credit at this rate in these geographies, and anyone who comes on the system that looks like that, just bid my money for me and let me know how my portfolio is doing.
So I may not get it all on day one because you may not have enough inventory of the appropriate risk levels.
That's correct.
But I'll get filled eventually, to use sort of street terminology, on that trade.
Yeah, in fact, you won't. Right now, you won't get filled on day one. But you will get filled over time and against those credit criteria.
Speaking of trading, we talked about regulation before the break. Who governs all of this in Canada and the U.S.? What kind of registration do you need? Where are we heading with this in the general regulatory framework?
Yeah, so we have yet to meet a Canadian regulator that doesn't have an interest in our business. We've yet to find one of those. Which, I think is a good thing for the most part. We have a very stable financial system here. We've got a stable securities regime. It took us about 2 years to go through the process of getting our service properly regulated to be compliant with the different laws. So we have to do, cost of borrowing laws, information privacy laws, credit reporting laws, all those things we have to participate in. But the overarching regime that governs us is the securities, the securities regime, and which of course is provincial here. So we have to work with each of the provinces that we're regulated in to get the appropriate set of licenses to act really as a broker and a manager of securities. So we hold a broker-dealer license in the provinces that we operate in, and we hold a portfolio manager license in the provinces that we operate in.
Just on your fees, you charge the borrower 3% up front, and then the lender pays 1% of the loan going forward per year.
So on the borrower side, it's up to 3%,
okay.
And it's dependent on their credit history. So you could pay as low as 1% of the loan amount to us for forming a loan agreement with one or multiple lenders. And then the lender pays a 1% or 100 basis points per annum on the loans we're managing on their behalf.
And when you add that all up, it's still less than some of the enormous spreads, even without the leverage that you see in the banks. So how does that translate into a better deal for both sides when you get rid of the bank along the way?
Yeah, so if you think about the way that banking works today, banks get capital at a very low rate, either through deposits or through securitization or GICs, and they lend out at higher rates, right? And they keep the spread. They have to manage their operational costs and their defaults. But the business of banking is a very lucrative business. Last year in Canada, the banks did about $120 billion in top line and about $29 billion in earnings.
Sweet.
Pretty good business, right? And it's the business of taking your money and giving it to you in loans. That's the business.
Now, sorry, Michael, because we're out of time, but not to end on a down note, but if the collection procedure doesn't work and the person just defaults, ultimately, me as the lender, I have to eat that, and that comes to the territory.
That's correct. Yeah, that's the risk of building a portfolio of loans on our system.
Fascinating stuff, though, Michael. I hope you'll come back because you have lots of insight into the whole consumer loan process as well.
Great, thank you.
Michael Garrity, CEO of Community Lend. Well, coming up, we've been receiving some fantastic emails from you, especially concerning last week's show on ABCP. We'll look at one in particular next on Alternative Investing. Welcome back to Alternative Investing. I'm here with David Kaufman of Westcourt Capital. We talked about the restructured asset-backed commercial paper market last week, and we got at least one email. David, let's have a look at the first one from Susan. David, I enjoyed your show on restructured ABCP from last week. I was quite persuaded by Jason Mark's discussion of the merits of buying this discounted paper in its current form, but it still seemed too good to be true. If it's such a great trade, why isn't everybody doing it?
What a great question, Susan. I get this question all the time. If this is such a great trade, why isn't everybody in it? Mm-hmm. And it's funny, there's an old joke about two economists walking down the street, and one of them looks down, there's a $20 bill, and says, hey, there's a $20 bill, I'm going to bend down and pick it up. And the other one says, no, there can't be a $20 bill there, because if there were, someone else would have picked it up already. And what that points to is the concept of the efficient market hypothesis, which is this concept, this theory that in the price of every security that exists in the world
is all the information.
All the information that exists, both private and public, so everything is perfectly priced. Well, we know that that's not true because inefficiencies can be created in two different ways. The first is that there's just a straight-up lack of information, whether it's private or public, that's available to anybody. And that it creates inefficient markets in the idea that one person can gain a little more information than the other. That edge can be converted, it can be capitalized into profit. The other, which is what we really talked about last week, because the restructured ABC paper is there for everybody to see and to assess, is a lack of expertise to digest readily available information. So the information's there, but not everyone knows what to do with it. And different people will use a different calculus to determine whether it's overpriced or underpriced, and the expertise plays a big part. So as Jason mentioned, specifically relating to the ABCP trade, is that there are many American institutions that have a long history of being able to measure this stuff very well, who are gobbling it up and who have over the last year, along with the folks at GMP Investment Management who have been doing the same trade. And so it's not like this trade is not being... there's no interest in this trade. It's just that it's still there, and there's maybe the sweetest fruit has been picked already and the lowest hanging. But his point is that there's enough fruit left, that this trade is not done yet, because the nature of opportunistic trading still is that the greatest opportunity is at the beginning if you're the first person to identify it, and then as more and more people see it, the value of it may still have some legs, but the value will be less because you'll have to pay more to get in, and then eventually it will converge. And so the last people in typically don't lose, but they don't make, because everybody knows what's going on. And this is one of those cases. So in short, Susan, everyone's not doing it because they don't either know the information or they don't have the skills, the expertise, the experience to be able to digest it. And the final thing is, people may recognize that this exists, but you also have to have a significant amount of capital in order to do that. And so there's a lot of smart people out there that might have PhDs, but they don't have the capital to back up their own theses.
Very quickly, what's on next week's show, David?
Next week, we're going to be talking about tax and alternative investing. So it's a very timely part of the year to be talking about tax. And our guest will be Stella Gasparo, a partner at Myers Norris Penny here in Toronto. And what we're going to address is tax from a couple of different levels. The first would be the kind of taxes that are paid inside a corporation or inside a different organization that does your investing for you and works with your money. And then tax in your hands, in the investor's hands. We're going to want to know about the different treatment of return of capital or dividends, capital gains, interest, rent, everything along the way. What it will do is it will allow, once we have a conversation with Stella, she's going to help to illuminate what it is that investors should be thinking about before they enter into an investment from a tax perspective. Because in the end, it's not how much you make, it's how much you keep. And I'm sure that she'll repeat that next week. It's all about understanding before we look at risks, we look at other things along the way. But what the taxes are on the way in and on the way out are key in determining where we should place our money.
David, thanks very much.
It's my pleasure.
That was David Kaufman of Westcourt Capital. We're out of time on today's show. Remember to email us, alternativeinvesting@bnn.ca, if you have any questions for David. Thanks for watching. We'll be back next time at 11:30 Eastern, 8:30 Pacific.